Keith is a badass. Keith is where I hope to be 20 years from now. So take that as you listen to both of us and as you take both of our opinions, much more weight should be put to Keith's opinion than mine, just so you know. This will be fun. So the goal here, as you and I discuss, Keith, we're going to keep this casual. I'm not interviewing you. You're not interviewing me. We are going to have a discussion. We're going to talk about some 2000, mainly in the current time, right? Everybody knows your story. Everybody knows my story. Okay. We're going to talk about how 2021 went for you, how 2021 went for me. We're going to make some predictions and we're going to answer some questions. People want to hear about some of the deals that we're doing now and what we think is going to happen. And you're at the helm of Gelt, much, much larger than my company, but we're in equal situations, right? We're trying to responsibly deploy capital in an environment that's changing rapidly. Tell me about the end of, you can kick it off. Tell me about the end of 2021 for Gelt and just what you're seeing out there right now.
Yeah, no, for sure. Definitely our firm's a little bigger, but we've been doing it 13 years, man. You're after only a few years, you're like light speed ahead of us. So you're on your way for sure, man. And I love your business model. I think it's really interesting. And I think you have a great niche, you know, and I think, so yeah, end of 2021 was pretty wild. Usually the fourth quarter for us is pretty slow. A lot of people go out of town and deals don't come out till January. We have an industry event called NMHC, the big industry conference every year, and people sort of wait to put out the deals then. But we had a plethora of deals. A lot of it was because of 1031 exchange. We had some sales go down that we had to find uplegs for, and just pretty wild quarter. I had a lot of people working through the holidays, which I feel sort of sad for. And normally it's quiet time, but I mean, even myself, I was, you know, during our little vacation on the computer nonstop and just making sure these deals went down smoothly. And we rewarded everyone with some serious bonuses, but it was definitely a crazy end of fourth quarter for us.
That sounds the same as mine. I mean, we closed half of our volume for the year in December because everybody wanted to get out before capital gains, right? We got an opportunity. I mean, I hated making a stressful December, especially between Christmas and New Year's for the team, but it was, and we bonused everybody out and we closed a lot of deals. And now I was looking at call volume on Ring Central because we're managing these assets as well. And we are getting hammered by calls right now because it's Monday after the new year. Yep. People call to pay. People just got, acquired basically. And it's been wild. Did you guys...
We had a sale at the end of the year go down because the same reason the seller, knew cap gains were getting hiked up and they wanted us as a stipulation to, enter this contract. We had to close by year end. So it was a really quick time fuse and we had to work really fast. But at the end of the day, it was a really solid deal, off market kind of thing. We don't do that many off market. So it was a special deal and we closed it like a few days left before the year end. So.
Beautiful. And are you still mostly multi, right? You got a few storage deals, mostly multi?
Yeah, so I'd say 90% of the portfolio is probably multifamily. You know my story. I'm pretty entrepreneurial, and I try to see opportunities where others don't, zig when others zag, kind of thing. And we started buying mobile home parks 4 or 5 years ago. We did very well with those, but it was pretty tough to scale, and we exited. And then self-storage, we started buying 3-4 years ago. I've always wanted to buy them. I just didn't have the right person at the helm to really run it for us. It's sort of, in our system, we don't go do something unless we have the experience, unless, starting the business, we didn't have any experience, but I wanted to find the right person to lead it. And yeah, we started with 1 and then 2 and 3. And yeah, it's been also sort of difficult to scale, but we are finding some opportunities and we're up to 11 self-storage properties. A little different than you because they're in larger MSAs and different style of yours are more.
Yeah, yours are class A, right? Maybe class B, some of them, but
yeah.
Let's talk about the one in Tennessee. You're a couple years into that thing, and how's it going?
Yeah, so when we closed on that in March of 2020, we were scared shitless. When everything was getting locked down and no one knew what was going on, and we historically have never really retraded anything, but we couldn't close on our loan. The CMBS, it was a CMBS loan, and that whole market was like just shut. The door was shut and we had to keep extending. And we got a little price reduction and we're like, it's gonna be a bucking bronco. But after a few months, we started seeing we're hitting our 7th year NOI numbers after like a year and a half of ownership. And we were anticipating like 8% cash flow, things like throwing off double or more. I mean, it's pretty wild to me. So
I thought I was the only genius, Keith. I thought I was the only genius having double-digit cash on cash over here.
Oh no, this is like total luck. We saw the fundamentals like in the market. We saw there was very little new supply coming online, and it was a chance to get a good size portfolio. We bought 8 of them in one shot. But yeah,
we won't name the actual city, but I'd say it's a second tier town, couple hundred, 500,000 people or so, and so you're hitting 7th year NOI numbers at a year and a half.
I don't understand 100%. I was talking to KK who runs it for me.
That sounds right. I mean, it sounds right.
You probably would know better than me why we're seeing these numbers being hit. I mean, I see rents are spiking in the apartment space right now also, which is wild to me. But yeah, just crazy time.
Yeah, you go through I mean, I love the first of the year because the first thing I do is log into all of my softwares and look at revenue for 2021, right? And where we were projecting it, I pull up the models of when we raised the money, where we were projecting it and where we actually are. We generally underwrite about 15% year one revenue growth, which is really strong. I think as an operator, like that's a big lever that we can pull is like drive revenue really quickly. The deals that are greater than 6 months ago, we are 41%, 48%, 49%, 57%, 25%. That was a dud. 38%, 21%, and 53%.
What's driving that really though? Like the NOI is this top line revenue or
that's
NOI?
Just top line revenue. Yeah. So NOI, we're even higher above our projections. I mean, look, crystal ball 18 months ago when this all happened, you point to what asset class to go into, and it was self-storage. I mean, even the REITs, these REITs that are as big, as much revenue, hundreds of stores are 15% year over year revenue growth, which is just insane, right? That's Google style revenue growth from self-storage. So yeah, the tailwinds are taking us.
Yeah, it's not normal. And I have a friend that sold a lot of his buildings in this space just because the public companies bought them at just really crazy numbers. A lot of it wasn't even built yet. It was future development sites. And definitely in the short term, yeah, it's really crazy what's going on. But long term, I think it's a great space. And I love when you come in, you're buying from mom and pops and you could lift that revenue 15% minimum. And, normally I would think, wow, that's a big number. And people would be like, oh, that's great. But it because you've done it so many times and you could see, they're probably running it, close to as full as possible, keeping rents low. And then, it's pretty wild.
It's a big dilemma for us because, first of all, yeah, public storage is valued at a 2.5 cap right now, right? The REIT, if you buy their stock, it's valued at 2.5 cap of their earnings. I know that's not how public companies are, much more complicated than that, but that's the way I look at it. We're in a dilemma right now because we're losing a lot of deals. We still only buy 1 out of every 5 or 1 out of every 10 deals that we get close to with an LOI. And we're underwriting 15% revenue growth. We're achieving 40 or 30. Our expense ratio is obviously much different too when revenue grows that fast. Our expense ratio is lower. So we're trying to have a meeting saying, oh my God, at what point do we need to get more aggressive with our underwriting because of this data we have? I don't know. We're probably going to stay disciplined because we're still able to buy, but it's a dilemma right now.
On marketed deals or just owners that just aren't taking, because a lot of the stuff you're buying is sort of off market. You send a ton of mailers out, like you're really aggressive on finding the needle in the haystacks and you seem to find them. So when you're not buying deals, is it because you're having owners that just, you're not hitting the number or you're losing out on marketed deals?
We lose out on most marketed deals. Off market, we have a little bit more leverage, but these owners haven't really raised rents in 5 years. So there's a lot of pent up revenue growth that they just haven't realized. So that's the dilemma, right? We're buying facilities that are charging $50 for a 10 by 10, raising rents to $99 for a 10 by 10, and then renting units this month at $117 for a 10 by 10. It's wow. It's mind blowing. But where do we think self-storage is going in 2022? People want to hear the predictions. I think it's going to be harder and harder to find deals, especially if with rates low. More and more capital wants exposure to self-storage. Every time a guy like Keith or Nick or Public Storage has a quarterly call and says, hey, we're booming, business is the best we've ever seen it, this is incredible. Every time that happens, more people take notice, more people want to buy storage. So it's going to be really hard to find deals. People are saying Chris Powers says 50 basis points of, debt, the interest rates go up 50 basis points. Where are you at with that, Keith? How do you feel about or what you're planning and preparing for? I know what we think might happen and what we are preparing for. We can kind of talk about those two things separately.
Yeah. I've given up early on in my career trying to predict where interest rates are going. And
Yeah.
so we've historically done like 10-year fixed rate debt, which has really hurt us on deals that we wanted to sell before the 10 years, because rates keep dropping and no one wants to assume those loans. And I look at it as sort of a just uber conservative. Like, I know what my debt service is going to be every month for 10 years. And, you know, it's, you know,
I'll kind of fill in there before you finish. CMBS has a ton of defeasance, meaning if you get a loan for 10 years, it's an interest only loan for 10 years. It's really good for cash flow, but defeasance is really bad. You basically have to pay all the interest for the remainder of the loan. So defeasance can be $10-15 million sometimes on a $30-40 million loan.
Yeah, it's pretty crazy, but the rates and the term and everything, even CMBS or in multifamily, the agency loans, like these 10-year fixed rate Fannie and Freddie deals we've been putting on. And, you know, we just did our first few bridge loans that have floating rate debt and shorter maturities. They're 3-year loans, but with 2 1-year extensions. So they're essentially 5 years, and we are thus taking interest rate risk. But my goal is to take those out as quickly as possible. So do the renovations to the buildings and you know, increase NOI and try to take them out as quickly as possible. So we couldn't get enough leverage on these new acquisitions with the agency. They were only going up to like 55% or so. So we levered up to 65 to 70 with bridge. And even though we were offered a lot more, like up to 80%, we didn't take the max proceeds kind of thing. You know, I'm a big believer, like I always talk about, if it was my own money and I wanted to gamble more, and, you know, sure, I could hit higher IRRs by taking more risk and levering up more, but I don't want to take that kind of risk. It puts you in such a scarier position because, you know, your debt service is higher, and then when the loan comes due, you owe a lot more. And what if, you know, values are down? You're gonna have to either sell at a loss or put up a lot more cash to refi the loan. And so we're just,
this is tough. I mean, this is the ultimate risk versus reward, right? That you and I have to balance. And when we use less equity, more debt, the IRR is much better. The returns can be juiced to the extreme, but you're doing the same thing I'm doing. We're levering at 60% on acquisition of loan to value and 54% loan to cost after all of our closing and renovations. That hurts, right? It hurts the IRR, it hurts the cash on cash yield, but I mean, it reduces risk for us, right?
You're never going to lose any money for investors if you know that's you're using that kind of low leverage and stuff, right? Like, so I'd rather, like you, preserve the track record and never lose any dollars of principal, and, you know, have maybe a little bit lower total return than you could have if you levered up more. And what kind of financing? I know your purchase prices are relatively small in these sort of, you know, smaller markets. Are you able to find like bank debt, CMBS debt? Like, what kind of financing do you put on these things usually?
We have the exact same that you just talked about, your bridge being a 3-year floating term. We get 2 years IO if we're at 60% LTV, which helps a ton. That interest only period helps us a lot. But then we don't have those 2 years extension. So I'm even more stressed than you about loan maturities. And my goal in Q1 is going to be, even the deals that we bought a year ago, 12, 14, 18 months ago, we're going to try to place that now with, we're trying to figure out whether or not we go to CMBS, or there's kind of so much value to add on a lot of these deals that we're seeing. We might try to just lock in a 5 or 7 year loan with on balance sheet with some, we're okay with rate risk because our cash flow's there. What we're really afraid of is maturity risk right now.
Yeah. But do you find like local banks to lend on these kind of properties, or like what's the,
I'd say some bigger regional banks, KeyBank. We're going to start looking at JP Morgan, Wells. KeyBank wants the stuff off their balance sheet, right? They want to have that 3-year term, and then they want to place it with CMBS. It's a machine. KeyBank is one of the biggest lenders in the country. They're really good. They provide an awesome bridge debt product, but they don't want it on their balance sheet long-term. So we're working hard to find another on balance sheet lender that's not agency or CMBS that can take on these loans for a longer period of time.
Do you think ever any of the big REITs and bigger players would ever like do your strategy, but acquire guys like you that have a lot of smaller assets, like in these smaller markets, because right now they're primarily buying certain facilities that are larger with on-site personnel, right? Like different.
Yeah, that's the difference. I mean, your Class A assets that you have there are Class B, you could probably sell them at a 3.5 cap, right? Our style, I mean, we're buying at an in-place 5, but it's very mismanaged. We try to raise it to a 7 or 7.5 or 8. and then refi at a 6, right? So we're playing much higher cap rate ball right now because the REITs are not in our game. There's no Extra Space, CubeSmart Public. They're not going to attack what we do because they don't have a single store. They don't have the ability to manage anything remotely right now. So it crushes yield to put a manager on all of our properties.
Yeah.
So,
but you have that dialed in that space. And I feel like once you hit a certain size, you could probably sell the portfolio to them. If the going rate is 3.5 cap, you could sell it for 4.5 cap, even though one-offs, you can't sell that much. But as a whole, I think one day someone will walk to your door and try to buy the whole portfolio once you have enough size. And, it's.
Yeah, I look at it as that's one of the levers that are outside of my control, but would be really nice. I think 10 years from now, you're right. Those guys will eventually do remote management. The technology's coming, like they're getting more open to it, and acquiring a company like Bolt, who has 500 stores and 75 employees on a management team that are really well oiled, like that makes a lot of sense. So that would be the dream scenario, but I'm not.
That would sort of put you out of business unless you work for the new acquirer or you did a massive 1031, which I know some people that just did. So how many stores are you up to right now and stuff?
We have 42 with a little over 1 million square feet. And then we have another 6 and 200,000 square feet under contract to close in the next 2 months. So we're still a long ways off. We need to block and tackle for another 3 years.
20-some thousand square feet, your average facility, right?
Our average acquisition per deal was like over 100,000 square feet, meaning we'll buy a portfolio of 5 smaller properties, but it's 100,000 square feet. Our per property average right now is 26.5, but this next wave that we're going to acquire is over 30. So I kind of talk like we're buying little small ones, but we're growing, as you do more, as you hit more scale, you kind of have to do more deals, a bit more bigger deals, right? So we're finding some nice assets. We're finding 50,000 square foot properties. We got one in Virginia under contract for it's almost 60,000 square feet. We're kind of sneaky getting some nice assets. So I'm excited about that.
Yeah, no, I'm just thinking about our portfolio. Our average, self-storage property is around 70,000 square feet, probably. I don't know what the industry average is.
That's institutional, right? When you have 70,000 square feet, you can have a full-time manager on site, and it does not hurt your yield when you're doing over $1 million in revenue a year, right? Our average store is 250 to 300,000 in revenue. So a $70,000 in payroll crushes the yield. But yeah, so all right, let's talk multi now. People want to know kind of how you're shifting from, 70s, 80s buildings to newer, buildings in core places. You're upgrading your assets, doing some uplegs and 1031s. What are your kind of, how did you see the end of 2021 going as far as the product out there? And where do you see 2022 as far as multi-family goes?
So we use the time right now to sort of churn the portfolio, I guess, get rid of the older sort of 70s, 60s, 70s legacy buildings that we bought right, but we're starting to have a lot of problems, and they got hit really hard during COVID with collections as well. And we use this time in the market when things like the old buildings are trading at similar cap rates to newer ones. So, and then the markets that have historically been very boom and bust are growing right now really well, but like they're trading at lower caps than core, like Southern California kind of deals, which has always been the inverse. So I'm like trying to zig when others zag kind of thing, and upgrade the portfolio to newer and then upgrade the location. So we sold, for example, 2 properties in the Seattle blue collar suburbs of Kent and Federal Way. And we also sold 2 properties in San Antonio that were like the lowest rents in the portfolio and got hit really hard during COVID. We had issues with collections, et cetera. We still profited on both. They were probably our lowest returns ever, like 7, 8, give or take IRRs, but we used that old money and put it into newer things, which I think will do much, much better. And we bought a 2009 built in Anaheim, so core Southern California location. Still has a lot of value add because when they delivered it during the recession, they sort of skimped out on all the finishes. So we are coming in and spending around $15,000 per unit, renovating, lifting rents $300 some per month. I heard we were already like $100 below when we projected. We're hitting $100 more.
Oh my God! So yeah. your revenues and asking street rates are just exploding as well. Wow.
Yeah, on the multifamily, yes, rents are spiking like crazy. I mean, we're seeing 10 to 25% like from year over year, from leases that new tenants to old tenants. It's pretty crazy. And yet we're still struggling on some collections in like certain markets like Portland a little bit, and so it's a weird time. So
do you think it's because this shift of like going after shitty assets. I mean, I'm going after shitty assets. I'm raising tons of money. I'm getting cheap debt.
Mhm.
Do you think it's because a lot of people are syndicating? A lot of smaller real estate private equity companies have all of a sudden they're flush with capital. Their LP base is just more and more and more. So we're going to go out and overpay for 70s, 80s stuff with copper pipes. I mean, that's craziness.
Yeah, I think it's good while the music's good, and like, our friend Elliot on it always shows like hot potato kind of thing. Like if you could keep passing the potato, but then eventually you get stuck with a moldy potato, you're going to be in trouble. When like I remember in Phoenix, rents dropped from peak to trough 20%, during the recession. And yeah, I mean, we were touring buildings that were foreclosed on that were like really good looking and stuff, but the debt came due and the values were way down, and the person or the owner or whatever couldn't, they either short sold it, lost it, they had big issues during that time. So especially with older properties, like it becomes a snowball. You don't fix this happened, like it deteriorates really quickly. So that's why like we're starting to try to just upgrade the portfolio, try to get 2000 and newer everything, and it makes it easier to hold long term. We try to be long term holders of everything that we own.
Yep, I love it. So let's talk a little bit about risks that we see, potential risks in 2022. I'll go first. I think obviously we are a debt fueled. When debt's cheap and easy to get, real estate values are great. When debt is expensive and hard to get, real estate values are shit. The real risk is the leverage, right? I mean, my loan maturities are the number one risk factor in my business. Interest rate risk, I feel like I'm somewhat protected because our debt yields are north of 10 portfolio wide. So we can take very expensive debt right now and we'd be okay. We'd keep our buildings, but I mean, the values would drop, right? I tell every LP in a call, I'm saying, okay, we're on a 12-year run. Everything's going phenomenal, but let's talk about the risks here. And there were guys who did exactly what we're doing in 2007. And it took 10 years until the building was more valuable than what we paid for it. And, will that happen in storage? I like my chances, but that's the kind of thing we got to think about. So I think the real risk is, we enter a debt crunch, inflation takes over. I mean, there's arguments on how inflation affects different businesses and different asset classes, but if the Fed jacks up rates and we're at 5% again, nobody's buying 5 caps. Nobody's buying 6 caps in my business. Nobody's buying 3 caps in your business. And we're stuck holding on. Right. And that's when I guess we go by. I mean, how do you think about the risks in 2022?
Yeah. I mean, I think definitely if interest rates go up and, cap rates follow interest rates. However, that being said, if we're seeing strong rent growth, to compensate for the rising interest rates, I mean, who knows? But one of my mentors, Sam Freshman, always told his investors, and I tell my investors too, that the building value, could be and probably will be, let's say 1, 2, 3 years worth less than we pay for it. But who cares? Like in the long run, you think long-term 5 to 10 years, the building value is going to be up, the rents are going to be up. Like you just got to be able to hold through the tough times. Right. And I think by doing lower leverage, like you're doing, you buy buildings where you're throwing off tons of cash flow, you're not going to be hurt. I mean, how can you, you have such a margin of error, right? Like,
so the risk, I guess, is in non-cash flowing. I mean, do you think developers are taking a shitload of risk right now when they're
development? Definitely, you have rising, construction costs. Their margins getting smaller and smaller. They're building to lower and lower cap rates. Definitely, just there's a lot of lag time in development. It takes in certain markets, 3-4 years to get something built. So it's like definitely a lot higher risk in development. We do.
You got bridge loans. That's a lever outside of your control. You got 3 years of timing, right? Who knows how the hell the economy is going to be in 3 years? Exactly. The people who did it 3 years ago are looking like geniuses, right? But the people doing it now, it's a gamble.
Yeah. So we build, but only in like high barrier to entry markets like Southern California in our backyard. And, definitely it's been a challenge finding good sites, and with rising, costs, and it's hard to, how do you peg the rents 3-4 years from now, interest rates, it's just, definitely a lot higher risk, but you got to get compensated for that. So you got to really bake in a big margin of profit in case, these things happen and stuff.
Yep. All right. So this has been a wild economic environment. Maybe this is normal because I haven't been doing this very long. Maybe this is normal that every year and a half things change quick, right? Cap rates go up, cap rates go down, debt gets cheaper, rents go up, rents go down. And then I read books and, about these real estate developers in New York City, these guys who, dealt with the depression. Then they dealt with the 40s again, it collapsed. In the 80s, it collapsed again. And, 2001, then 2008. I mean,
it's cyclical. It's definitely cyclical for sure.
So it's always changing this fast, or does this feel different to you, Keith?
I'd say seeing rents spiking like this after a major worldwide, epidemic, pandemic, like it's really wild. Like, who would have thought, the economy and the stock market and all asset prices, like you can't predict anything. That's all I believe in is in the long term, like it's going to be good to own these things. It's, but in the short run, no one can predict anything. Like, it's impossible.
So you're just deploying the way you kind of think about it. If I'm reading this right, and you correct me, you're deploying capital in a way that 10 to 20 years from now, you're 90% certain you're going to be in a damn good position. And 5 years from now, you don't really care. 3 years from now, you don't really care.
I tell, there's different buckets of money in everyone's portfolio. And I tell our investors, this bucket of money is like, it's not as safe as like a bond, but it's damn near close. And like, you're going to get better returns and, with all cash flow, all the, depreciation, the long-term upside, but it's got to be, it's illiquid and put it asleep. And I like it long-term better than like seeing the stock market go up and down. It's very emotional. And like, the stock market was down 30%, right? During COVID, like March of last year or whatever, or 2020. And we didn't see real estate values, crash like that, right? There was just very little transactions going on during that time and stuff. And maybe there was one or two scared sellers out there but literally we tried to like get big discounts and stuff when that happened and no one was selling. So I think we, and values now are way higher and rents are higher and rates are lower. And so it's, you can't predict anything. It's this real estate's just a good way to park excess cash for the future and for future generations. That's the way I look at real estate.
I think it's a blessing that we have the access to capital and the business models to be able to do that. I think a lot of people listening might not have that kind of time, right? They don't have the model that you've built at Gelt. They don't have the access to LP capital that I have, that I can go out and buy self-storage facilities on that same strategy with long-term hold periods, with the fees for my team that we can eat, even if we're not doing deals. Like we don't need to sell a deal to make money.
Yeah,
it's a blessing that we can act like that. And I guess what advice would you give to the guys who are stuck doing some kind of, I wouldn't say more risky, but more speculative real estate deals, development, short-term debt, heavy value add? I guess just be careful out there and don't run out of cash would be my advice, right? If you run out of cash, it's over.
You gotta, yeah. I mean, I know some people have declared personal bankruptcy. They were worth $1 gazillion, and then, 09 happened and they lost everything. It's, I think you just gotta match your investors and equity to what you're doing, kind of thing, right? That's why if we were like into the business of buying and fixing and flipping and like maybe get a institutional joint venture going with someone, or, like just different kind of investor, we're partnering with individuals and families. Like this is their hard-earned bucks. And like, we want to just don't take that kind of risk and stuff, just be very, very safe. And we explain all the risks up front. And I think for the people that don't have the capacity to have long-term capital, I think it puts them in a tougher place to but we, in the first 5 years, we didn't make any money. I was living at home, like kind of thing with my parents, like literally shoestring budget, and just, rolled all our acquisition fees back into the deals and stuff. And
that's when it makes sense to gamble, right? It makes sense to get after it a little bit at that time.
Yeah. If you have not much, expenses and not much going on, then you could take those bigger risks. But if you have a family and bills, and it's definitely a scarier thing for sure.
Okay. So people want to hear a story about a tough deal that we closed down in 2021, or a deal that got messed up, or something along those lines. I can go first while you think about one that you might want to highlight. But we had been chasing an owner in North Carolina for probably 3 months. I'd been talking to this guy. I wanted to buy his property for 2.6 million. He wanted me to pay 3 million. We got busy with some other acquisitions. A month goes by. Now we're in September. It's getting closer. I call him back up and I say, how's the property doing? How are you? You know, how's the rent roll? He says it's doing great. And I'm like, well, would you sell? How about 285? Like, would you want to do 285? Right on the phone with him. And he says, it's got to be 3, Nick. It's got to be 3. My property's worth 3, doing 26,000 a month in revenue. Let's go. If you want to do the deal, you can, but it's got to close by the end of the year. Well, we lose track. He basically, we try to get him down another 150 grand. Should have just made the deal happen at 3 because it's worth 3. He stands his ground and he's like, okay, it's not listed. I don't care. I don't need this. I'll hold it. Well, we get a management report sent to him about 45 days before the end of the year, and it's a good one. And his rents are growing and he's 100% occupied. And we're like, all right, we got to buy this thing. It's a really good deal. It's at $3 million. Let's get the deal done. I call him up and he says, all right, well, you got to close by the end of the year. And we had never closed the deal under 45 days. We're like 37 days from the end of the year. And, basically we tried to orchestrate what would be a cash deal, meaning this would be in the same deal with another asset that's going to close after the start of the year. We raise all the money, we put in our money, we close on the first one in cash, finance them both at the same time to close on the second one. Go through it, basically get everything ordered. The last minute, the surveyor is 85 years old and his son, they both get COVID, so they cannot deliver the survey between Christmas and New Year's. We're going to be surveyless and we got to find a way to close this deal. Basically the title and the stuff that they were able to email us, basically we had the surveyor's wife go into the email, send it. It's not fully sketched or anything, but the descriptions were there. And we convinced the bank to go ahead and close. We liked the title work. It all looked great. And we closed it on New Year's Eve, the day before New Year's Eve. The bank actually funded it and it ended up working out. But that was a pretty stressful last couple of days. 2 days before New Year's, he called me, the owner did, very upset, very emotional. Nick, you have to close this deal in cash. Whatever happened to your cash offer, you got to get this thing closed. And I didn't have the cash in the account. We only had about 1.5 million in there. I was about to have to sell a bunch of equities personally and close on the deal. And ended up happening. Our attorney's very good. And I think it's a testament to the fact that our team has closed now 42 properties, right, in the last 2 years. And, you know, we're like seeing the time to close go down drastically, 90 days early on, because we don't have the systems built. We don't have a good relationship with the bank. And nowadays we are, you know, the last quarter, we averaged 47 days from contract to close, which is pretty damn good in some of these states we do business in.
Yeah, that's extremely quick and definitely stressful, I'd say. Yeah, we've done a ton of transactions now. We've learned from each one, you know, from our mistakes. And I think for you, I think if you haven't done it already, it helped us by getting our own lines of credit and stuff. So we don't have to sell our own personal securities and whatnot, or, you know, to be able to close, you know, quickly on things if we need a bridge for the equity. So we have our own personal lines of credit, corporate line of credit. I have a mentor that's in the early days used to help us close like a gap equity kind of close, because when you're syndicating, yeah, you have a lot of uncertainty. You don't have a commitment from an institution that's going to fund it for sure, right? You're passing the hat to a lot of wealthy people, but you don't know how much they're going to come in. They're individuals. They could change their mind. It's nice to have to start building, you know, credit facilities and stuff.
That's a good point. They don't actually lend on portfolios anymore, credit facilities. It's, I mean, debt is not easy as everybody makes it. You know, it makes you think it is to get, but our management company now has enough revenue to get a line of credit, and yeah, we're working on those things. I think the interesting part is that a lot of these LPs that we're bringing in are new. They just met me on my newsletter or on Twitter. I have a conversation with them on Zoom or something along those lines. And we have over 200 active investors now. The last quarter, we added 50 brand new people who had never invested with us before. And only 2 people failed to fund, 2, totaling like $120,000 that we were able to replace right away. So, I mean, if you're a professional with your system in Juniper Square and you have really clear expectations, you have all the documentation ready for them to review right away. I have been very impressed by the close rate of basically brand new people that are getting into our system. Have you experienced something similar?
That's great. Percentage wise, we're not adding that many people. We add maybe that number, but we have a lot more because we've been doing it so much longer. But I'd say that means they're all serious investors. They're getting their money in on time. I mean, we've tried to train our investors, you know, to get the money in on time, you know, before the close. And it's been a challenge sometimes. But yeah, I'd say definitely having Juniper Square, or there's other companies like that. When you have a lot of individual investors, it's definitely a lifesaver. With all the electronic documents and reporting and distributions, and it's worth its weight in gold for sure.
A couple more questions here. Andrew Gluck says, how do you deal with the principal versus agent problem, playing the AUM game and, versus the IRR game? And I'll be honest that it does weigh on you a little bit when you have investors saying, I need more deals. I need more deals. Mm-hmm. Part of you just wants to lower the leverage, reduce the risk, and just buy up everything, right? How do you balance that with, okay, we really need to find good deals? And we've already kind of discussed this. You talk about how you're buying in markets that you're pretty damn sure that 10, 15 years from now, this is going to be better than it is now, and we're going to be in good shape. For me, it's real. Yeah. I mean, we're trying to build healthy companies with healthy fees, and getting more AUM is a big part of that. But also, finding deals is getting harder. We're having to get more aggressive on our underwriting. It's definitely a struggle, but we feel like we've stayed disciplined, and I guess it's all about staying disciplined and not trying to get too greedy too quick and buy too much.
Yeah, it's definitely a balancing act. I think it's always, you got to look at the risk adjusted returns, I'd say. So definitely we're underwriting probably to lower yields than historically, but the building qualities, we're buying newer and in better areas. I'd say risk adjusted returns are still very, very strong. And, I'd say, it makes sense to most of our investors still to invest in these kind of buildings, because what are their alternatives, like bonds and, certain, buying the stock market, and it still makes sense, even though we're underwriting lower returns. But we're not trying to shoot for the moon and stars every deal, otherwise I'd have bought 2 deals only, right? We're trying to build a business, a legacy business that could be around past my generation. You need assets, you need investors. And I think we're just trying to find the best risk adjusted returns, right? So
it's about responsibly deploying capital in any market, in any environment, right?
Yeah, exactly. So like, are we going to go back to buying 60s, 70s? We might, if it makes sense, if prices, like if we could hit much higher returns. But I'll buy 60s, 70s if I could show like a 4x over 10 years versus, 2.5x. But if I could make a 2.4x on a brand new building, like, I'll buy the 2.4x over 10 years than right now a 2.5x or whatever. I'm just throwing out numbers on it.
Yeah.
It has a lot more risk. So you got to always look at
deferred maintenance is huge in multi, isn't it? Deferred maintenance, roofs, plumbing, appliances, HVAC.
We've had big major pipe issues that have costed us, $500,000, $1 million to repipe.
Oof.
$2 million. I mean, yeah. So like, definitely. And then, you always have to every 10 years, renovate all the units and stuff. And it's just definitely more costly to run. That's why I like self-storage, for that reason. And also I like self-storage because you could raise rents like that. Like you said, 20, 30, 40%. And nominally the dollars aren't that much, right? And in the markets we're buying the self-storage, it's like, they're all pretty full. So you can't bring it to another place. Like you're competing against the dumpster, like the guy from Public Storage said. That's your competition, right? Like,
don't have a dumpster on your site because it's your competition.
There you go. I mean, it's a beautiful business, especially if you're buying in a supply constrained area. I think you're not, but you're buying so cheap, it doesn't make sense to maybe build in those areas. You're not maybe getting the rents to build. You're not seeing much new supply come online probably in these markets you're in for the most part. I'm assuming.
If we do, it's unsophisticated, right? It's farmers that are putting up 1 or 2 buildings. We're not going to see a CubeSmart build 70,000 square feet and then spend 20 grand a month in marketing, when they come in to fill it. So we really like the way we're positioned, but a lot of other people just like me are going after these buildings. There's 2 other real estate private equity companies that are much larger than me that buy 300 million a year on the East Coast, and they're underwriting 25% year 1 revenue growth while I'm underwriting 15. So if we're competing against them, we're not going to be able to pay more than them.
Interesting.
Yeah. So good deal, man. Well, people they got a blockchain question here from Chris Halligan. He's a friend of mine. How is blockchain going to affect real estate in 2022? I think a lot of people think you're a crypto nerd, Keith, when I couldn't even get you to accept a free Bromato NFT by setting up a Solana wallet.
I'm just curious. I like learning about.
You're an investor, I think. You invested in that NFT.
I'm a professional investor, right? Like I just happen to be, 90% in the real estate space, and that's 90% of my brain. But the 10% that I'm not in thinking about real estate, I enjoy investing in the stock market. I enjoy learning about that. I enjoy, new technologies. I enjoy, just learning and reading and stuff. So the whole crypto thing is just really interesting, seeing it all play out. It reminds me of the early days of the web, like kind of mid 90s, late 90s when I was really young, and seeing a lot of new innovations, and, people thought it was a fad, and like a lot of there, but definitely there's legs to all this stuff,
Do you think it has an effect on real estate? To what degree? I mean, are people going to tokenize real estate? I hate to, I'm very open-minded, right? And I feel like I'm not a boomer, and I'm doing things a lot differently by outsourcing a lot of employees, no offices all over the country, using a lot of tech. And I just think this is so far down the line of needs in the real estate business. There's so many assets that are mismanaged.
Yeah, you're not solving a real problem. You're trying to create, you got to solve real problems. And I think, I don't know exactly, like, with cryptocurrencies and, blockchain and,
by making real estate liquid and tokenized, is that solving a problem? I think the fact that our assets are not liquid and that we hold them, I think that's a feature, not a bug, right? So making them liquid where they can be traded adds a tremendous amount of accounting stress and doesn't really solve a real problem for. I look at the average LP that we have and how, tokenization affects that, and it doesn't solve the problem.
Yeah, if they want crypto exposure, buy some Ethereum if you believe in maybe Bitcoin, or, buy, like I bought that CryptoPunk, like one of the first NFT projects. I bought 2 other things and I just sold them. I'm like, I'm not, I don't. I like.
We'll get you with a Bromato eventually, but I think that the last question here, Capital Fixation on Twitter says, does value add still exist? Are we all core investors for the next 10 years? And I think it all depends. I mean, Keith's strategy is going to be a core investor that follows the tailwinds and good markets, like buy good buildings in good markets and let the tailwinds take over. But I think there's absolutely value add. There are so many rich, lazy people in real estate. And what that means is mismanagement, right? I mean, you have submarket rents, you have buildings that are not taken care of. You have a lot of wealthy people that play golf and don't worry about real estate. And obviously there's meat on the bone for scrappy people who want to innovate and make things better. You can always make things better, right?
Oh yeah. You can make money in any market pretty much, in any asset class. Like there's, like you said, there's legacy owners that have owned stuff a long time. They keep it full, rents low. Like, you just got to be creative and just hustle, man, at the end of the day.
Yeah, everybody's got a different strategy. Everybody's at different phases of their careers. You're in the capital preservation, long-term capital growth phase, low risk. I'm somewhere in between. I think I'm a little bit of a balance, and some let long-term tailwinds hold these things for a long time, low risk, but I'm still in the nitty gritty, right? We're answering phones. We're doing a lot of the management, deploying a lot less capital than you are, obviously. But then there's people who are, you can buy one $500,000 self-storage facility in one suburb of one small town and sell it 2 years later for 1.5 million and change the course of your entire family's life, right? Just by getting scrappy on one small deal that's way too small for Nick, and obviously something Keith wouldn't even think about. So that's the beauty of real estate, right? To some degree, scale can be a disadvantage when it comes to really, really, really being truly opportunistic in a small market.
Yeah. I mean, you and I have, operations and a lot of staff, and, we got to, but if you're,
do you have any personal plans that you'd want to share, or goals of 2020? If we were to take a step back from how we kind of think about big picture things within our business, if we just talk about Keith Wasserman, you're building a house, maybe, your family goals, what's 2022? What are you looking forward to personally in this new year?
Yeah, just moving into the new house finally. We've been when we moved into our rental house in Santa Monica, we had 1 kid, and it was a pretty small house, and now we have 3 kids, so we're like busting at the seams, and poor baby doesn't even have a room. We literally have a curtain in the kitchen kind of thing. So it's gonna be nice moving from a small rental to a nice big house that my wife built for us. But that'll be nice, and just I'd say continuing, focusing on the business, buying one property at a time with one investor at a time, and just staying the course, man. Like still, observing and learning and, adjusting, but keeping at it for a long period of time and building the business. And, if one day at a time, make a little progress every day. It's the whole compounding thing. You look back and it's like, wow, and you're doing it on a shorter time frame. And how many years have you been doing it now? Not too long, right? 3?
Yeah, I think it's a tough personal balance for me because I'm always been a very business goal oriented guy who, hey, let's go, sprint. There's a zebra, there's a gazelle on the field. I'm a lion. I got to go chase it. I got to kill it. And now we've kind of built the machine. It's going. Our acquisitions teams are going. Our management teams are going. And time is doing amazing things to our portfolio. We just need time. So it's when I get too aggressive and too intense, I sit on my computer. I'm adjusting things. I'm just basically I have the tendency to mess things up, and that's when I can make some mistakes. So 2022 for me is going to be about one foot in front of the other, risk adjusted yield, cover our bases from a risk standpoint, and let time continue to work. And that's, but yeah, we're growing pretty fast, man. I mean, 50 million in 2021 was our acquisition. We just barely eclipsed 50 million acquired. Our goal is 100 this year, but it's really hard to set goals, right? You got to take what the market gives you. And, but yeah, our 18 months ago, our 5-year goal was to buy $20 million worth of storage. So it's been incredible what Twitter has done, and guys like you and Chris and Moses mentoring me along and helping me think bigger. And I think building it the right way so that we don't really shoot ourselves in the foot.
Yeah, no, you're doing great, man. Just keep up the good work. You got to treat your investors' principal like safer than your own. And, just be very transparent like you have. I see how you operate, and just keep at it, man.
I love it. Well, appreciate it, dude. This has been fun. I think people really enjoyed it. If you want to drop a comment over to the right, how we did, but yeah, man, this is good. I think we'll do this again.
Yeah, sounds good. Appreciate it, man. We'll talk.
Thanks,
soon.
buddy. Have a good day.
You too, man.
Juniper Square, the sponsor of our show, recently did a capital raising survey. And in this survey, they asked 142 senior executives at US-based commercial real estate firms a series of questions to understand the state of commercial real estate fundraising. It's an insanely valuable report with data on questions like, how much capital did you raise last year? How long did your last raise take? What type of investors are you raising the most from? And what strategies are working the best for you to find new investors? Download this report for free at junipersquareresearch.com. That's junipersquareresearch.com. Big thank you to Juniper Square for sponsoring the show. Thank you for listening to the Nick Huber Show. Just wanted to remind you that we have a paid real estate community where some really special stuff is happening. People are breaking down deals. People are networking. People are, I think, even formulating partnerships inside this group. We have over 100 members now. For more information, you can visit sweatystartup.com/REC. And the first 299 members of the group to get some momentum get $200 off the annual membership using the code FIRST299, FIRST 299. And also, you can check it out for 5 days for $1. You make a $1 payment, you can check out the community for 5 days. Highly recommend it if you're serious about bringing in some other people into your network, into your life, to help you become a better real estate investor.